LiteFinance, the world of financial freedom.
Hello, it's Tuesday already, September 5th, a bit late, but it is time to summarize what we can expect in the markets during this week. So, starting with the calendar, and then we will make broad fundamental analysis based on which we will prepare the plan to trade the Euro-USD. Okay, so yesterday we received poor GDP figures from Switzerland. Today we will receive, or maybe we already received, depending on the time of video publication, the RBA rate decision, where we should see no change to the level of rates. On Wednesday we will get GDP numbers from Australia, services PMI from major economies, and BOC rate decision, where as well most likely there will be no changes. On Thursday, we will get Eurozone GDP figures, and on Friday, inflation data from Germany. And that's basically about it in terms of the calendar. Now let's move on to the analysis of USD. So, stock indices can handle rising US Treasury yields, but can the US dollar rival currencies? Mixed labor market data for August brought the end of the Fed's monetary policy tightening cycle closer, which was good news for the stock market. Okay. However, the increase in employment by 187,000, better than Bloomberg's expectations, became another proof of the strength of the US economy. This circumstance forced the Euro-USD to drop below 108, while the Eurozone is balancing between stagflation and recession. The US economy is firmly on its feet. Yes, unemployment rose from 3.5 to 3.8%, and employment growth outside the agricultural sector slowed down from 238,000 per month in the spring to 150,000 in the summer. However, the latter figure is in the line with the pre-pandemic levels and a strong economy. Unemployment is not far from the half-century levels, and not surprisingly, experts at Consensus Economics raised their forecast of US GDP in 2023 faster than for its European counterpart. And there is an opinion that economic expansion does not die of old age, but the central bank always kills it. This time, the Fed's powerful arsenal can do nothing to the US. It seems that the Fed officials in the current monetary restriction cycle can reduce inflation without hurting GDP. In other words, it will achieve a soft landing despite the most aggressive monetary tightening in decades. The reason lies in deferred demand due to the COVID-19 pandemic, colossal monetary and fiscal stimulus, and the increase in real incomes of the population. Now, despite the rapid growth of rates in various countries, the Fed's mission seems to be much more feasible than that of the ECB. Jerome Powell and his colleagues are more efficient than Christine Lagarde's team. Along with American exceptionalism and divergence in economic growth, this fact contributes to the Euro-USD decline. At the same time, the market reaction to US non-farm payrolls for August looks excessive. The fall of the major currency pair was caused by a modest increase in treasury yields based on investors' belief in American exceptionalism, and however, the rally in stocks and the decline in the probability of the federal funds rate hike to 5.75% in 2023 from nearly 40% to less than 35% serves as a bearish factor for the greenback. Markets take a long time to digest information, especially the more important one. Therefore, the risk of Euro-USD rebound upwards will grow. However, the inability of the euro to rise above 107.95 to 108 and 108.35 to 108.40 will serve as a reason for entering shorts. And that will be all as for this late market forecast. Thank you guys for watching, and I'll see you in the next one. Take care and goodbye.